Okay, there we are. I believe we are live. Okay, so we'll kick things off. Hello, everyone. Happy Thursday. Morning for, I'm sure, many of you, and afternoon for others. Appreciate you all having availability to join us today for what should be a great panel discussion. I'm personally very excited to bring this group together, both our panelists and you all within the audience, on what I think is a really interesting topic, that being navigating sustainability and engagement in today's private credit markets in 2026. My name is Adam Davies. I'm a vice president at Mullock Partners, which is now part of SLR Consulting, as you can see by the little logo behind me in the background. We are a sustainability advisory business where I personally lead our private credit ESG advisory practice. So hopefully that connects some dots of why I will be serving as your host slash moderator today. In my role, my team and I are exclusively supporting lenders across pre-close ESG due diligence of all its different shapes and forms, as well as kind of a litany of other ESG advisory related topics, be it SFDR Article 8, PRI reporting, helping with LP DDQ responses and fundraising support, data annual reporting work, policy creation, you name it, we probably do it. And so all that being said, to set the stage ahead of introducing our fine panelist group that we have here today, I think it's worthwhile to first acknowledge that folks among the audience, you all, are likely here and interested in this topic for a multitude of different reasons. And from the quick glance at the registration list, I saw GPs, I saw LPs, I saw other advisors, I saw more even beyond that. And so it stands to reason that you each have your own unique motivations for being here. And of course, we want this to be time well spent for each of you. And so this is why our three panelists today represent across GP, LP, and industry network perspectives that may help to either represent or heck, maybe even challenge any preconceived notions that each person amongst you and the audience might have in a way that we hope you'll find valuable. And so to that end, I will turn it to each of our panelists to intro themselves and we will take it from there. So Paula, Amy, Aditya, please go ahead.
Do you want me to kick off?
Yeah, Paula, that'd be great.
Sure. Hi, everybody, and thanks so much for joining, and thanks so much to Mullock SLR for hosting this and inviting me. I'm Paula Luff. I'm head of sustainability research and engagement at DSC Meridian Capital. We are a credit manager based in New York City, focused on the high yield universe. The instruments we actually invest in are liquid, but we invest in the high yield debt and levered loans of mostly private companies. I would say about 60 to 70%. We started our sustainability journey about 6 years ago. We're a young firm, we're only 8 years old, at a time when we were able to really build it into the investment process before we started growing. We have 3 funds, one of which focuses on climate.
I'll go next. Hi, everyone. Thank you, Adam, and Malk for having me today. I'm really excited to be here, and thank you for everyone who's attending the webinar. But I'm Amy Johnston, and I'm a portfolio manager on the alternative credits team at APG Asset Management. I'm based in New York, but our private credit team invests in private credit funds, and so our mandate includes everything from direct lending to distressed capital solutions, also asset-based finance and real asset credit. And yeah, I'm very, very happy to be here today to provide more of the LP perspective.
Thank you. I'll go next. Hi, everybody. Welcome to the session, to the webinar, and great to be here. I am Aditya. I lead private markets at the PRI, mostly focusing on private equity and private debt as an asset class, but then also increasingly have been involved in the real asset sides of things as well. My background beyond the PRI is private markets investing across the cap stack and across jurisdictions. Great to be here.
Thank you each. Appreciate it. Very excited and honestly very grateful that you could each be here and join us today. So now let's set the stage a little bit more on the subject matter, the task at hand, and address why we are all probably here for this discussion. So many of you are probably familiar with the state of the private credit markets over the last few years. There were words like renaissance getting tossed around. You had PE-like returns for a fixed income strategy, crazy, incredible. And then you fast forward to within the last 6 to 9 months, and the picture is understandably a little bit different. Now, the word cloud, if you will, around this asset class probably looks a little bit less rosy for some. You have headlines of BDC withdrawal limits, you have rising interest rates, you have default rates under closer scrutiny, you have words like SaaSpocalypse that have now been added to our collective vocabularies, and then a few of these larger bankruptcies in the private markets that have showed evidence of some cracks in the wall. And so that said, we now sit in this new dynamic where some folks, of course, may say it's all overblown. Others are expecting that this truly is the new normal, and I'm sure kind of everything in between those two poles. So that may reasonably lead some sustainability folks, I'm sure you all in the audience, to consider, should I be adapting my approach to sustainability in this asset class with everything that's been going on? And so the hope is for the next call 30, 35 minutes is to address exactly that. And to best do that and to aid in the discussion and help you all see not only capturing what you're only thinking for yourselves, but also what your peers are thinking, we're going to be releasing 3 interactive poll questions to you all along the way. So whether it's the intel that you can get from the polls as you see the responses populate, which names are anonymized, that can help you kind of see where your sentiments shake out relative to those of your peers, or if it's just the discussion that follows with myself and the 3 great panelists that we have. Our hope is that you'll all leave here today with some fresh ideas, some new perspectives before lunchtime on the East Coast. So that's enough of my preamble. Let's kick things off by starting with the first of our 3 poll questions to lead us into the discussion. So Kat, if I can ask you to release that question, we can get going with it. Cool. So you can see here, the question is, do you feel that the news across the private credit markets in the last 12 months should change how GPs run their sustainability programs? So as you answer, feel free to do so. And what we'll be doing over the course of this webinar is starting to get a sense of not only what you all think, but this will also be the first opportunity for our panelists to respond. So for avoidance of doubt, when we say sustainability programs here, we mean all of it. That's diligence approach, that's policies, that's how you respond in DDQs, team trainings, portfolio engagement, borrower engagement, frameworks with which you choose to align, anything along those lines. And so again, as a big fan of sentiment data, the hope is that you'll find some of this real-time data getting populated as useful reference. But I will turn it over, and I will take a little bit more of a back seat now. So Paula, representing the GP perspective, curious what you think of this question.
Yeah, I mean, look, I think we all tend to react to news, right? And what's the latest sort of thing that's buzzing about. But at the end of the day, I think we have to go back to basics, irrespective of the asset class. Why are we doing this work in sustainability? And is it adding value to our investors and to the companies we invest in? And if it's not creating value for either of those key stakeholders, then we probably should think about tweaking our approach. If it is, then I don't think headlines should be shaping what we're doing.
Yeah, that makes a lot of sense. And Amy, just representing what you see or would expect GPs to do from the LP perspective.
Yeah, absolutely. So similar to what Paul's saying, but for us, the short answer really is no. Like the recent news in private credit really hasn't affected how we run our sustainability program. And that's because at APG, we really do take kind of more of a top-down overlay approach where our responsible investing framework kind of has 3 components or 3 sub-frameworks. So one kind of pillar of that is ESG risk management. And then secondly, we've got impact where that's more about calculating and generating kind of real world outcomes. And then the third kind of leg of our stool is regulation, which like is compliance to SFDR, for example, or other frameworks. But how we incorporate APG's responsible investing approach into private credit differs, of course, from private equity and other asset classes, but the macro news around private credit really has not directly affected our responsible investing program.
Very helpful. Then Aditya, I'll kind of ask you what you're seeing, just speaking from kind of the bird's eye view that you have. What are you generally seeing from whether it's PRI signatories or otherwise? Are lenders generally pretty tied up in what the market is doing and how that should influence their sustainability programs, or do they also see it through the same lens of Paula and Amy as it should just kind of continue to be status quo?
Yeah, I mean, obviously it depends on who you ask, as you've seen different views from both of our co-panelists. I think like from our side, from speaking to our signatories, it's a bit of both, right? Because the question isn't about yes or no, or whether sustainability matters less or more when markets become challenging. It's, as Paula was saying, it's about which issues now become financially material to the borrower and therefore relevant to the credit outcomes in a changing market environment. So for example, in periods of stress, we are seeing investors are becoming more focused on the financial materiality. They're becoming more focused on fundamentals and probably downside risk. And that's where, I mean, that's exactly how effective engagement from a sustainability perspective should run and how it should add value in our view.
Yeah, yeah, I think that makes a lot of sense. So the net here is that when you do encounter more stressful times in the market, it shouldn't necessarily dictate whether you should be turning your program on its head just to accommodate potentially a more distressed borrower base or things along those lines. But hopefully there's already the programming in place that allows you to engage in a thoughtful way where it's necessary. Anything, Paula, that you're typically seeing as far as how you engage and how you kind of identify these things such that in your program it allows you to keep being status quo even when the market does kind of shift beneath everyone's feet?
Yeah, no, I appreciate the question. Our sustainability approach is very integrated into our bottom-up fundamental research process from sourcing to exit. And we were able to build it that way because of how young we were in our own journey. And so there's, what are we seeing? Well, it depends on the business environment, right? And so what we'll look for, obviously, we start from a point of financial materiality. I think most folks in our world do that. But when we are looking at the impact of a sustainability factor, we try to translate it for management into things that they're actually paid to execute on. So free cash flow generation, cost of capital, risk management, security prices, and in the case of the privates, exit multiple. And if we can't make that connection for them, they will politely listen, but they may not execute, right? And so we'll actually, instead of saying, you should do this, it's the right thing, or you should do this because we think this is a risk, we have an idea for you that we think might be value accretive for your company, and we'd love to talk to you about it, is the approach. The engagement process is led by me and the analysts jointly, right? They don't know who's the fundamental analyst on the call and who's the ESG person. And we do that very deliberately because we want management to connect business outcomes with sustainability outcomes where that's appropriate. And so that's been our approach. And sometimes the issues change. Sometimes, look, it is much easier to gain traction with a company when they are in stress and distress. There's no question. But if you make a business case, at least you'll get an audience, is what we have found.
Yeah, I think that makes a lot of sense. And so speaking to kind of the value accretive nature through which you would be engaging, there obviously has to be something there that is compelling to, be it a sponsor, be it the management team of the borrower themselves, to make them think that this is something worth doing. This is now a topic that I want to kind of transition a little bit into, and it'll lead into our next poll question. So Kat, if you're able to release that, I can give a little bit of a preamble here. When we think of what is value accretive, there is the pure upside focus of value creation, which is something that is long more thought of in equity context than in credit. Many people do disagree and think credit absolutely has a seat at the table in value creation. And then, of course, downside protection, risk mitigation, those sorts of pieces. So curious what you all think, kind of as the lead into this particular piece of the pie. For lenders, do you think that risk mitigation and value creation have a seat at the table in the pre-close underwriting process as you're assessing opportunities, or is it really more one than the other? Okay, so I'm seeing some of the responses rolling in thus far, and it looks like right now about a 50-50 split through about 20 responses thus far. Interesting to see no focus on value creation whatsoever. I do think that kind of backs up the fact that value creation is perceived to be more prevalent in equity contexts, insofar as you can have both, but probably not just value creation in private credit. And so I think that that's kind of interesting. Paula, speaking to what and how you engage with your borrowers, and you want to make sure that it is value accretive here, are you thinking of it through both of those lenses on your side?
Yes, we are, but I think it depends on the stage of the investment process. So when you're sourcing ideas in credit, I think our inclination is to look first at risk mitigation. We're taking default risk in high yield. And so I think it's a very much a risk-oriented conversation in the diligence process. But over time, there are often, we particularly in our climate fund, where we're focused on decarbonization and the energy transition, we try to also look very deeply at how is decarbonization and the energy transition going to impact this company? And are there any opportunities for innovation, new lines of business for them
Right.
as a result, right? As opposed to just managing the risk. But that tends to come beyond, at a slightly later when we've taken the position, not necessarily in diligence. It can,
Right.
but I think the focus again is on we're taking default risk. Is there anything here that is scary?
Yeah, no, absolutely. And then I guess, Amy, from your perspective from the LPC, do you expect GPs to look at it through a certain lens?
Yeah, so I can kind of answer it two ways, but yeah, for like as when we're looking at funds to allocate to, yeah, we definitely think sustainability should play an extremely important role in the GP's underwriting process. So it plays a huge
Right.
role in our underwriting process, but then we also expect it to play a pretty significant role in the GP's underwriting process, where similar to Paula's point, where they're looking at analyzing those ESG risks alongside any other financial risks when they're looking at companies to lend to. So that's kind of on the risk mitigation side. But then we do see, of course, within private debt, it depends on the sub strategy in terms of like the way that you're engaging with those managers. And then, of course, we're fully aware that there is a lack of influence versus an equity owner, that you'll see on the private equity or the infrastructure side. But when we're underwriting managers, we're really looking to make specific recommendations or engagements where that manager is, but then looking at them to take it a step further. And so how that's kind of shaken out is on with our direct lending managers, we're typically seeing that our engagements or recommendations are through more of a value creation lens. So when we're underwriting them, we're still asking these ESG risk mitigation questions, and we're expecting them to do so in their underwriting process. But when we're engaging with them, with the actual manager, it's through more of a value creation lens. And then when we're working with distressed or more like capital solutions oriented managers, our recommendations and engagements do tend to still be within that risk mitigation lens as well. So hopefully that's helpful to kind of paint the picture for both how we're looking at the managers, but then what we're expecting them to do with their potential portfolio companies in their underwriting process.
Yeah, it absolutely is. I appreciate you sharing. And Aditya, to round it out with you at the end, you had kind of mentioned yourself around considering bear cases and a more prudent underwriting environment, just given everything going on. Do you see it similarly, that it could be kind of a both lens? Maybe it is a little bit more staged. One is happening before the other, depending on where a borrower sits within the pre-close versus post-close process, but kind of curious what you're seeing and thinking from your end.
Yeah, definitely both, I would say, from a GP perspective. But given that we're speaking about the pre-close process, I would say risk mitigation probably comes first. And for lenders, that's always mostly the starting point, which is protection of capital and thinking about risk mitigation. And that's what they prioritize at that stage. But then lenders also realize that engagement or effective engagement can also improve long-term company performance and therefore support value creation in the long run as well. But we typically see that happening post-close much more effectively than pre-close, given time pressures, competitive constraints, and various other factors.
Yeah.
Let me just jump in one more time, just real quickly. I think what people, people often feel that, credit is not a great place to do sustainability engagement, but we forget sometimes that, unlike with either private or public equity, there's an actual use of proceeds associated. Now, it may or may not have a sustainability outcome, but very often it's project finance that does. And that I think is a huge differentiator for folks operating in credit.
Yeah,
In the
yeah,
space.
absolutely. I completely agree.
I mean, it's catalytic capital. It just may not be labeled as such.
Right,
Yeah.
exactly. So all that to say, I think we can get even more deep into the engagement and monitoring and post-close side. I know we covered a little bit of the pre-close. Maybe risk mitigation has a little bit more of a foot in the door in the pre-close that can lead to the value creation and some of these other conversations that may happen in the post-close. So as we kind of navigate to engagement, so post-close, what things should look like. This does lead us into the last of our 3 poll questions, which Kat, if you're able to release that whenever you're able to, that would be great. So now this is an evaluation from you all, just to gather some thoughts. Do you all find it easy or difficult for lenders to be able to engage with their borrowers and influence the sustainability programming that happen on their end? Again, I use sustainability program very, very broadly here. It could be anything that is material or relevant to that borrower's sustainability profile. So it could be privacy and security in the software world. It could be avoiding instances of ecological or biodiversity harm if you're an agribusiness borrower. So we'll kind of gather some thoughts here. Okay. Seeing a lot right now through the 11 responses, seeing a lot of 4s, but we'll give it a little bit of time just for folks to respond. Again, it's a measure of how difficult a lender finds it to engage with their borrower base currently on sustainability topics. Okay. Seeing that we're leaning a little bit more on the it is hard side of the spectrum here, Paula, I guess going back to you, it's making that business case. When you're having these sorts of conversations, you've identified maybe pre-close that there are some cracks in the wall here that could use a little bit of extra support, another perspective. You need to show that commercial accretive value add to the management team. What goes into your process to lead you from finding an issue to actually having a productive conversation with the management team on that issue? How much do you need to do to get to the point at which you think there will be enough conviction to really engage here?
Yeah, so for a new, I think it kind of depends. One of our learnings is that founder-led companies can often be very hard to engage, particularly if the CEO and the management team have been on seat for a long time. And that's whether they're private or sort of publicly traded. So that is one, there's attributes of certain companies that are just, that make them very difficult to engage. But we will look at, do we know anyone at the sponsor that we can talk to, right? And I mean, that's one of the first things my CIO will say is, who do you know at X firm, and can we talk to the deal team, about this issue? And very often the sponsor has identified the same issues, and so it's a question of, can we reinforce each other's sort of storyline here? So that's one thing. Typically, when we're about to approach a company, when we do the underwriting, we do assess what the impact of some of these factors could be on free cash flow, et cetera. And then we will benchmark that company's peers. And generally, what we do is we share that benchmarking with management, and we can find something that they do relatively well. But, typically they're not first quartile, right? And in my experience, I was a corporate executive for a long time before pivoting to asset management. There isn't a CEO alive of any company, public or private, who aspires to be fourth quartile in anything. Right? They're very competitive that way. And so we'll say, hey, this really does matter to your business, and this is why. Your peers are doing this a little bit better, but we can help you, right? And we offer pretty extensive technical assistance to our companies if they want to avail themselves of that. We don't force it on them, but most of the time, high yield companies are very resource constrained. They don't have a 10-person sustainability team, and are very happy to get my support and the support on the fundamental side of our CIO. And so that's how we approach it. And most of the time, companies are very receptive, regardless of whether they are private or public, with the exception of these sort of cult of personality CEO type enterprises, which, it's understandable. There's a lot of groupthink in those boardrooms, and they're not always receptive to new ideas. And that's fine. If they won't engage with us, in the case of our climate fund, and they're a very high emitter and we can't help them kind of decarbonize, then we won't hold them in the portfolio, right? If it's hopeless, we have other funds that we can hold those kinds of securities in, but not our climate.
And do you think that the current climate, again, you do have the program that you already have, you are committed to kind of keeping it as it is, but where there is an environment with the perception of more distress, people trying to really make sure that their entire balance sheet is as ironed out as possible, do you find the current environment favoring the ability to engage more? Has there been a difference in the reception amongst CEOs now versus maybe 2 years ago?
Look, I think there are broader issues right now facing companies. It's not that they don't care about this stuff, but they have real supply chain challenges. There are huge geopolitical challenges that are also, very much affecting the bandwidth, right? That said, our climate fund, we thought, look, in the US, it's no secret that the environment is not favorable to sustainability, right? The political environment. That said, our Climate Action Fund has more than doubled its AUM in a year because there are LPs that still care about this work, feel it's fundamental to business performance, and again, if you tell a CEO, look, energy is your second, your energy expense is your second highest, your highest expense. What are you doing about it? That they may not be, and I may not be asking him or her about their emissions, but that's kind of what I'm asking them about, right? Your costs are spiraling in this space. You are dependent on grid energy. You're a data center. What are you doing about it, right? You're operating a data center in Texas. There's no water there, right? These are business constraints, and it doesn't really matter whether you believe in climate change or whether you think sustainability is fluff. These are real business concerns for particularly our high yield universe, which tends to be very resource intensive, right? Waste, energy, water.
Yeah.
And I haven't found them any less receptive. What we have found though is when companies are stressed and distressed, you have much more opportunity for change, right? When a company files for bankruptcy and the creditors own that company, it's an amazing time for business transformation. And of course, we always focus on the capital structure first. That's what they come to us for. But once you repair that, that capital structure, then there are opportunities for real transformation, whether it is on the governance side, whether it's on sort of improving the management team or finding those sustainability issues that will generate value over time.
Yeah, absolutely. And you bring up a great point about the ability to really, during times of stress, be able to actually operationalize change for the better. Before we get too deeply into the kind of distressed lens, I'm curious, Amy, for your thoughts from the LP perspective. Just back on the engagement topic for a second, when you're looking at GPs and how they engage their borrowers and what is productive engagement, certainly no GP wants to just engage for the sake of engagement. They don't want to be a thorn in the side of a management team or the sponsor. Does APG have an opinion on, for example, what a right level of engagement should be, whether it's an engagement program and identifying these certain themes or topics with which to engage the portfolio? Some GPs have 200 plus borrowers, and maybe 200 plus engagements is not the right solve here. It's just finding the right and thoughtful 20 or 30 or whatever that may be. And so I'm curious kind of what goes into APG's evaluation of a GP and how much or how little they should engage.
Yeah, so I'll try to answer kind of the different parts of your questions, but the first part that stuck out is kind of what are the different parts of engagement for GPs. And so when we're underwriting a GP, our diligence questions are typically centered around like ESG process, policies, the people, the program, reporting and sustainability risks. And then when we're looking to engage post investment, I would say at the time we once we underwrite a manager and we're investing in a fund, we always will have recommendations for that GP, and the level of recommendation just depends on, again, where that manager is and where we can push them further. So this isn't always the case, but generally we'll find that European managers are already further along, so we're able to push them a little bit further, whereas US GPs, they simply are not as far along. And so our engagements, we're still looking to push them further, but they're inherently just not as far along as the European managers. But I would say the ways that the recommendations that we're making and the engagements that we're having with managers depends on the sub strategy. So it depends if it's a direct lending manager or a distressed manager. So there will be nuances, but our engagements are really more, again, on the policies, the program, the types of the higher level pieces to like a responsible investing framework. We'll go more into the weeds on like specific climate recommendations and alignment with certain frameworks that we need to see. So that's kind of at a high level. And then at the more nuanced level, in our quarterly reporting from managers, we do, look line by line at portfolio companies. We're looking at various metrics. And then if there are specific points where we do need to see some engagement or where we have recommendations, we'll make those as well. But we're generally starting from that kind of higher level lens at the manager level as opposed to the portfolio company level.
Yeah, no, that's helpful. That's great. And then Aditya, I'll ask you the last question here on the engagement piece, and then we'll really sink the remaining 5 to 10 minutes on the distress side. What are you generally seeing among signatories in terms of how engagement programs are made? Is there any flux that you've seen or noticed or been, had discussions on with signatories and call it the last 12 months around how they're trying to engage their portfolio in light of everything that's going on in the market?
Yeah, I think from a GP perspective, there's definitely I would say catalyst for deeper engagement given the current market situation, and it's true for periods of uncertainty anyways, whereby in those scenarios you'll see lenders increase more monitoring, dialogue, information exchange. But I think in the current scenario there's an even bigger opportunity to focus on topics that are more material. And if you are, say, for example, as an investor investing in a turnaround situation or a distressed situation, and then there are certain topics which become more important from an investment case than would have been otherwise. So there's less focus on what I would call peripheral engagement topics in such a scenario, and more focused on more tangible, let's say, operational or turnaround related topics. So that's what I think we are seeing in the current context, which was highlighted by the other speakers as well. One thing which I'd like to add to this whole discussion, because we're talking about engagement and influence, is that influence from a private debt perspective lies on a spectrum of various factors. So it's not always linear, and those factors can change for a lender. It could be factors like market conditions. It could be factors like timing, where you sit on the cap structure. And very few lenders have the maximum influence at each of these spectrums on each of these factors. But then equally, very few are at the very bottom of all of them at the same time as well. Right. So essentially, there's always some opportunity to engage and influence outcomes to a degree, irrespective of the degree of influence you might have across various of these factors under consideration.
Right. There's a level of nimbleness that's required with understanding where you sit in it all and how you can convey a compelling story, and whether that's a story worth engaging on, and if you have the ability to do so. And so it does lead into this last piece of the puzzle here around just really focused on distressed lending and how to perpetuate strong engagement where it is appropriate. From the consultant standpoint, when I'll talk with GPs, I generally see that in the context of distress, in the context of turnarounds, you have to really pick the best arrow in the quiver if you want to engage at all, because turnarounds and distress scenarios, they're a very stressful time for all involved, and you really have to be thoughtful about, is sustainability something that should be even near the top of the agenda here? And so in the context of these distress cases where a covenant is breached and maybe there's more equity control or board seats or the ability to tell rather than ask, Paula, from your end, what do you think is the thing that GPs should do to best approach sustainability engagement in a turnaround?
Yeah, I think I sort of tipped my hat a little bit earlier, but one, focus on the capital structure first. That's mission one. And then figure out, is there a sustainability factor that really, really matters, or two, no more than two, right? Going forward. And if not, don't do it. Yep. But if yes, we had a case of an airline restructuring where, look, fuel and emissions matters. They're regulated in Europe. They're regulated in other places. They had customers that cared about, corporate customers that cared very much about emissions and their own scope 3 emissions. This was important, right? Because the strategy they had and the practices trailed the rest of their peers, and the exit was public. You don't want anyone exiting at that kind of disadvantage, right? And to an IPO. So, and sometimes it doesn't matter, and that's okay, right? Focus on the capital structure. Not a great answer, I guess it depends. But do not focus on boiling the ocean. One, maybe two things that you really think matter to the business and can make that case.
Right. Do you think it's always, when you think of the situations that can bring a borrower into a position of distress, maybe it's just the market doesn't like the product, maybe there's some underlying fraud, impropriety, maybe that's
Right.
leading to penalties, maybe there's a collapse in the supply chain someplace. You have all these scenarios that could bring you into distress, and not all of those things are ESG related or sustainability related.
That's right.
But when you're trying to pull yourself out and do a successful turnaround and navigate some of the financial tumult that can happen, you're dealing with things like cost cutting. You're dealing with things like supply chain renegotiations. And when it comes to your people, when it comes to your supply base, whatever that may be, there usually are some kind of sustainability implications as you pull yourself beyond that. Where it's not, though, that first driver, what leads you into here, is there room to talk about sustainability in some of those cost-cutting things to pull yourself out, or do you feel as though that may not be that one or two things that you had mentioned?
I hate to be a waffler, but it kind of depends. I mean, for us, what we're looking for is not just, necessarily the most distressed opportunity, but a company that's in distress where we believe that if we repair the capital structure, it's a good business for whatever reason, not going through a rough patch, whether that's COVID, whether it's something
Right.
geopolitical. So we're not necessarily seeking the most distressed opportunity out there. It's really about, is this a good business worth saving, right? So that's where we start from. And I think, again, it depends. And it depends on who else is in the bankruptcy and what the creditor committee is really focused on, and can you make your case? And in a couple of cases, speaking with our partners, have said, there's really nothing to be done here right now. Let's wait until they're further along and maybe exit bankruptcy and see if we still own the securities, what we want, or if we reinvest, what we'd like to do. In many cases, it's fundamental to the restructuring.
Yeah.
Again, if you are, a company that is very resource intensive, chances are that something in the sustainability realm is going to matter to the future kind of prospects of that company once it emerges.
Yeah. No, makes total sense. And I agree. Like, yeah, I think it does depend. I'm a consultant. I say it depends a lot, but for good reason, right? Like
Right.
it does make sense. It's a nuanced approach. And so Amy, I'll pitch it to you now from the LP perspective. Obviously, LPs like APG would want to make sure that their GPs are thoughtfully managing more distressed borrowers in their fund. That goes without saying. When it comes to where sustainability plays a role in how those borrowers may be managed, or when the GP does have an equity stake or board seats with the tripping of a covenant, is there anything specific that APG is looking for, or is it kind of similar to what Paula had said around just being thoughtful in the moment?
Yeah, it really does kind of echo what Paula says. I mean, I think it's a great question, and maybe down the road we'll see that it changed. But when we're underwriting distress managers, we're not looking for them. We're not saying, okay, well, when you get some post reorg equity, like we expect you to have a lot more influence and do X, Y, and Z with this portfolio company. We really aren't playing for that level of influence when we allocate to distress managers. Our focus really is more on making sure that particular manager still has, we're engaging with them where appropriate, and again, trying to push them further. We still hold their portfolio companies to the same standards as whether that company's in distress or not. So irrespective of that particular company's, balance sheet. But I have not seen a scenario where we've seen one of our managers take a company through bankruptcy and focus on sustainability issues first. I think it's exactly
Right.
what Paula said, is where they're trying to get, the balance sheet and company, really turn around the company, and then they'll focus on one or two of these more pertinent issues secondarily.
Mhm.
That may change in the future, but yeah, today it really has not been kind of front and center.
That makes sense. This will be my last question. I'll pitch it to all of you to respond as you so see fit. When you have these distressed kind of cases, you do have these turnarounds. You have GPs that suddenly come into a position of more owner than just lender. There's equity on the table now. We had talked earlier about risk mitigation versus value creation. As we discussed, value creation sometimes plays a more evident lens. On the equity side, you have unlimited upside potential here. So when lenders suddenly come into a position of that upside potential, should that make value creation with distressed loans become more at the front and center than what might have historically been just the risk mitigation? Like the risk unfortunately wasn't mitigated. You're now in a turnaround scenario. What do you do about it?
I'm gonna waffle.
I know.
I think it
Depends.
depends. I mean,
Sure.
at the end of the day, if it's got to be a going concern coming out, right? And sure, when you're a lender or you're buying, a liquid credit, your upside is capped, right? But in a way that it isn't with equity. But as a credit investor, we're in a turnaround. We don't want to own that equity forever. So, it's not our bread and butter. So, I don't really know. I think each situation is different. It also depends on who else was on that restructuring committee and what their priorities are. We're not ever going to be the lead creditor in something necessarily at our size. So, it's a cultivation of the other folks and understanding their priorities and what they're willing to focus on and not, and making peace with that.
Yeah, I think that's really well said, because we're not looking for our distress managers to hold on to that equity either. We're looking for them to get out. So,
Yeah.
so we're not,
Right.
again, playing for that really long-term upside. Yeah, so I know it is kind of a hedging answer, but it's true. So yeah, I think it's
Yeah.
a little
No,
more challenging.
yeah, that makes total sense. Aditya, any thoughts on your end on this?
No, I have a very similar answer. I used to work on the distress side, so it depends a lot on the position you have in the cap stack. Where what's your end game? What other instruments you're holding? So many other things, right? So I think the key is that in a distressed or a turnaround situation, as others have said already, sustainability should focus on issues that are directly or more directly linked to business recovery. This is not the best time for a long wish list of initiatives, if I may
Right.
use that word. So you have to kind of prioritize, but you should support the turnaround plan, not sit alongside it, if that makes sense.
Well said.
Yeah,
Mhm.
completely agree. Well, all that to say, I know we have 3 minutes left in our allotted time. Kat, thank you for posting in the Q&A session that folks are free to drop in any questions. I don't know amongst the audience here if there are any questions, any thoughts, responses, commentary, opinions based on anything that's been said in the first 43 minutes, but we can give it a little bit of, call it 30 seconds of airtime just to see if anyone does feel strongly. Happy to tackle those live or can pitch to any folks on the panel if it's more relevant to their specific case. And otherwise, if any final remarks, kind of as a little bit of a holding mechanism, Paula, Amy, Aditya, anything else that you guys feel is worth peppering in the last moments here?
Nothing from my end. I think the questions you posed were well thought out, and I think it was interesting with the polls to kind of see some differences in views, but hopefully we were able to shed some light from the various perspectives.
Yeah.
I mean, I think from my side, if there's one takeaway that I would say is it's that engagement in private debt or stewardship in private debt is not like a nice to have that disappears in certain markets and comebacks in other markets. I think what happens is the form of engagement changes, but when you have periods of uncertainty, often those periods make borrower engagement, risk mitigation, risk oversight, or materiality even more important. So the question isn't whether to engage, but how to use probably the expanded toolkit of influence that you have in certain situations than others.
Yeah, and I think from my perspective, we always think of engagement as kind of one-sided, the manager going in and telling a company sort of what to do. For us, I think what we have learned is that engagement has been hugely value accretive to our investment process. It has made us much better investors. We learn so much more about the companies we are investing in, their industry, what makes management tick, and that translates into, frankly, just better outcomes for us. But we much more effective position sizing, better understanding of the sort of risk opportunity calculus. So my my plea is don't think of engagement as a one-way sort of, let's get value out of this as the manager, but it's really a two-way street. And it's been, we've learned much more from our companies than we have taught them in the last 5 years.
Yeah, well, great. Thank you so much to the three of you for joining. It was lovely to do this with you, to prep on this with you. I just really appreciate each of you sharing your perspectives. I think it's so valuable to be able to represent the different sides of the coin when it comes to topics like this. And being as we are at the 45-minute mark, I think not seeing any questions in the Q&A, we can wrap it up here. So if there's any follow-ups for me, for anyone else on the panel, I'm sure we're happy to hit those as a separate point. So feel free and we can coordinate contact information and get the right people in touch with the right people. But otherwise, appreciate everyone in the audience having some time today. Hopefully some of the poll questions were valuable just to see where you sit in your opinions relative to that of the other folks in the audience. And if not, then hopefully the discussion was valuable and gave you some perspective that can be useful going forward. So all that said, thank you so much for the time. Paula, Amy, Aditya, thank you so much for being here, and appreciate everyone's time today.
Thanks for having us.
Thank you for having us.
Likewise.
Bye.